Welcome back. Now, mounting political and regulatory interference have weighed on ESG strategies. And according to Conway Williams, head of credit at Prescient Investment Management, risks to sustainability lie in the geopolitical forces disrupting ESG principles. Conway joins us now for a look into how 2025's tariff shocks are forcing businesses to rethink their ESG strategies, supply chains and risk frameworks. Thank you so much for your time, Conway. Now, I definitely knew that the Trump presidency would disrupt the ESG landscape because of the elevated fossil fuel priorities, but I actually didn't think that tariffs specifically would disrupt ESG, goals and targets at this point and how companies view them. And I want to know, is this direct or indirect?
I think it is both, indirect and indirect.
Yeah.
But if I just let the data talk for itself, and that is what we at Prescient try to always let the data narrative talk, is that if you just look at the recent conference board survey, more than half of the 125 largest institutions and companies in the US are actually no longer using the term ESG. They're reframing it. In substance, they're still continuing with sustainability initiatives, but because of the actual issues around it, around ESG and greenwashing and the likes, they are actually reframing it. From our perspective, it is still the same. We've seen ESG as a measure to consider non-financial risks, and we systematically embed that in our investment process. But the important part of what you just asked was that it has delayed, it has resulted in more confusion, it has put ESG on the back burner and sustainability initiatives on the back burner because tariffs make things more expensive. And if it makes things more expensive, people have to rethink whether they can actually prioritize sustainability or not. That for us is a big concern.
This is actually so interesting because I also have a friend who works in the ESG landscape, and she's actually been saying that her clients are kind of trying to navigate their way around the kind of political uncertainties and ambiguities at this point, but actually they haven't really changed, their ESG goals. But also, in terms of how companies are viewing ESG at the moment, have they moved beyond seeing it as a compliance checklist, and as much as they may now maybe be calling it sustainability in terms of ESG, have they moved beyond seeing it as a compliance checklist? But also, is it difficult to put a case forward for ESG as a strategic and profit imperative?
I think as a custodian of capital, we have a fiduciary duty to actually deploy capital in a responsible manner.
Yeah.
So if we are asking the hard questions on ESG, on whether it is non-financial risks or whatever you want to call it, then companies have to take it seriously. And again, we discharge our fiduciary duty by looking at financial metrics, but then also non-financial metrics. So as I said earlier, it's much of the same for us, but we are not following a tick box approach. We actually believe that companies that can weather the next crisis, whether it is another trade shock, whether it is climate change and the likes, are the one that are putting responsible investing or sustainability at the forefront of what they do. It is actually more costly not to do things than to actually take ESG off the table completely. And we are seeing the various frameworks, for example, double materiality frameworks that are coming to the fore, where people are actually saying, what are the financial impacts of not doing or doing less, and what is the financial impact of the material issues that they need to cover? So not only thinking of ESG in a tick box approach, but actually thinking about what makes a difference, whether it's financially, whether it's from a risk perspective, or whether it's just from an impact perspective. There is a big move, not only from the investor side where I sit, but for companies, because they have to take it seriously, else they won't be able to obtain capital. And they won't be able to weather those storms in the long term.
Yeah, and talking about obtaining capital, and of course coming from, being a capital allocator. Are the private markets more fertile, and do they have more appetite for ESG investments? But also, how then do companies take advantage of those opportunities?
I think the first thing is that in the alternative space or in the private space, we are definitely seeing a resurgence or a marked uptick in ESG aligned initiatives, whether it is to support South Africa's REAP program, whether it is broader infrastructure. The reality is that we have a massive infrastructure gap. We have massive inequality within South Africa and in the larger African continent. And with that being said, there are opportunities, massive opportunities for us to deploy capital that actually improves the developmental narrative. And the developmental narrative is what's actually going to reduce those inequalities and the likes. And we are then able to structure opportunities and get better reporting, improve governance at companies, and actually embed improved sustainability practices in companies. So I do think we have an advantage over the usual listed space because we drive terms a bit better. But I think it is definitely a fertile ground for whether it's clean or green initiatives or broader infrastructure initiatives, hospitals, education, and the likes. Lots of opportunities out there, but we need companies to take it serious or projects to take it more seriously, and in that way, then being able to obtain the capital from us as allocators of capital.
Well, just lastly, as we wrap up the conversation, Conway, where does South Africa fit into all of this? Of course, as we also have to really take in the pressure of global political interference, but also just as a continent in general. Can regional integration in Africa help push the ESG agenda forward?
So I think Minister Tau last year spoke about AFTA and how that is actually going to be a diversifier against tariff and global shocks. And while we want to think of it as a hedge against geopolitics, it is actually a way for ESG to improve or for us to improve ESG sort of initiatives. If you think of us being able to sell to Zim or to sell to another local African country, it shortens supply chains and it reduces emissions. Again, those type of small wins, in addition to hedging against geopolitics, means that sustainability initiatives aren't actually more expensive. And it actually embeds that responsible or sustainable thinking. The other question that you just asked is South Africa, what is the impact of all of the tariffs on South Africa? The reality is that tariffs makes things more expensive, whether it's inputs or outputs. And again, if things are more expensive, then your supply chain needs to be redeveloped. You have to rethink the way you buy and sell things. And that then delays sustainability initiatives. So we are not an island unto ourselves. We are actually part of a global market. And when there are these sort of geopolitics, it definitely does disrupt things. But it doesn't push things into an area where we don't want it to be. We are still, as a country, very much ESG aligned. If you just think of all of the reform or the reform agenda being pushed by the government, there's actually a lot of positives that can actually bear fruits for the debt capital markets or just for the SOEs and municipalities out there. We just looked at 11 different pieces of legislation recently that's actually going to change everything from electricity, deregulation, to logistics and the likes. So there's definitely a positive spin that is coming, and we hope that that can translate into more opportunities and then development for the country as a whole.
All right. Well, thank you so much for your time and really connecting the dots for us in this area. Really appreciate your time, Conway. That was Conway Williams, Head of Credit at Prescient Investment Management.